Hello there. I'm Howard Marks. For the last 50 years, I've had a front row seat to the markets, and I've seen the same patterns, the same mistakes play out over and over again. My goal today is simple. I want to demystify this thing we call the market cycle. I want to help you see the patterns that so often lead good people astray and show you how to start putting the odds in your favor. So let's begin with what I think is the single biggest illusion in all of investing.
So you've heard this a million times, right? The stock market returns about 10% on average. It sounds so nice and neat. But if that's the average, why doesn't it just happen every year? Why do we have to live through these crazy, wild swings, these massive booms followed by gut-wrenching busts, instead of just a steady, predictable climb?
Well, the answer is actually pretty simple, but it's profound. It's because the average is not the norm. You see, the market isn't some perfectly oiled machine. It's a reflection of us, of people. And the reason for all those swings is human psychology. When people get excited and swept up in greed, they push prices up to euphoric, unsustainable highs. And then, when fear inevitably takes over, it forces a painful, sometimes brutal, correction on the way back down.
I've always found the best way to picture this is to think of a pendulum. Its average location is that happy midpoint, right in the center. But it actually spends very, very little time there. Instead, it's almost always swinging toward one extreme or the other, from euphoria and greed on one side, all the way over to pessimism and fear on the other. And here's the key. The movement toward one extreme is what provides the energy for the powerful, inevitable swing back.
So if we want to navigate these swings successfully, we have to learn to think differently from the crowd. But most people, they start out with what I call first-level thinking. And let me tell you, it is the most common and, frankly, the most dangerous mistake an investor can make.
So what exactly is this first-level thinking? Well, it's really seductive because it's so simple. It's just a superficial reaction to whatever is obvious, to what's right there on the surface. It looks for easy, single-step answers. And because it's the path that almost everyone else takes, it virtually guarantees you'll never achieve anything better than average results.
A classic example of this is when someone says, "Hey, I really like this company's product, so I'm going to buy the stock." Sounds logical, right? Well, back in the 1970s, this exact thinking led to a disaster with a group of stocks called the Nifty 50. These were the can't-miss companies of their day. The thinking was that they were so great you could pay any price for them. People were paying 80 or even 90 times what the company earned in a single year for one share of stock. But when the market turned, investors in these supposedly great companies were absolutely wiped out. The lesson wasn't that the companies were bad. No, the lesson was that the price they paid was dangerously, recklessly high.
And this experience taught me what is probably the most important lesson of my entire career. And if you only take one thing away from our time together today, please let it be this. It is not what you buy that makes you a successful investor. It is what you pay for it. That relationship between the price you pay and the intrinsic value, what a business is truly worth, that is everything. The only way you can create a margin of safety for yourself is to buy something for meaningfully less than its underlying worth.
So, if we want to get superior results, we have to move beyond that simple, superficial approach. We absolutely must learn to engage in what I call second-level thinking.
Now, second-level thinking is harder. It's more complex, it's more nuanced. It requires you to think about things very differently than the crowd. I mean, think about it. How can you possibly expect to get better than average results if your thinking isn't better than average? You have to see the complexity others miss, and then you have to have the courage to behave differently based on that insight.
The great economist John Maynard Keynes described this perfectly with his beauty contest analogy. Imagine a newspaper contest where you don't win by picking the face you personally find the prettiest. No, you win by picking the face that you think the average voter will find the prettiest. The first-level thinker just picks their personal favorite, but the second-level thinker stops and thinks, what will most other people choose? Investing is exactly the same. It's not just about what you think of an asset. It's about understanding what the rest of the market thinks, and then figuring out where that collective perception might be wrong.
Let's look at what that looks like in practice, side by side. The first-level thinker sees a good company, and their simple conclusion is, buy. But the second-level thinker asks a series of questions. Yes, it's a good company, but is it a good company at this price? They see that everyone else loves it, which has pushed the stock to a point where it's become overpriced. And their conclusion? We should probably sell. One simply reacts to the news, the other anticipates how the market has already reacted to that news, and maybe overreacted. Okay, so the real skill here is to apply this second-level thinking to figure out where we are in the market cycle, to, in effect, take its psychological temperature.
So let me ask you a question. Where do you think the greatest investment risk truly comes from? What is the most dangerous possible environment for an investor to be in?
The answer might surprise you. It comes from the widespread belief that there is no risk. I call this the perversity of risk. Risk is actually highest when investors are absolutely convinced there is none. When everyone believes an asset can only go up, they get complacent, they take on too much leverage, and they drive its price to dangerous bubble-like levels. And conversely, the greatest opportunity is born out of panic. When everyone is terrified, that fear drives prices so low that buying actually becomes the safest thing you can do. It's one of the great paradoxes of this business.
Of course, it's one thing to sit here and talk about this philosophically. It's another thing entirely to live through it. For us at my firm, Oaktree, the ultimate test of this whole philosophy came during the global financial crisis in 2008.
We had been preparing. Back in 2007, it was just clear as day that risk aversion had completely evaporated. No one was cautious anymore. So, well before the crisis actually hit, we went out and raised an $11 billion fund dedicated to distressed debt, which is basically buying the debt of companies in trouble at deeply discounted prices. And then we sat and we waited for the opportunity that we felt was inevitably coming.
And then, in September of 2008, Lehman Brothers collapsed, and there was absolute sheer panic in the streets. In the middle of all that chaos, I sat down and wrote a memo to our clients. And the logic I laid out was really, really simple. I said, look, either the world's going to end or it's not. If it ends, it really doesn't matter what we do with our money. But if it doesn't end and we fail to buy these incredible assets at these ridiculously low prices, then we simply haven't done our job.
Now, I never want to give you the impression that doing this is easy. We were not a bunch of emotionless robots calmly executing a pre-written plan. We were terrified. I was terrified. Acting in direct opposition to the entire world is a deeply uncomfortable, stomach-churning feeling. But you have to have the conviction to do what you believe is right, especially when it feels the most difficult. Most great investments begin in discomfort.
So, how can you apply this in your own decisions? It really all comes down to a framework for balancing the two fundamental risks that every single investor faces every single day.
Every day, you're facing two distinct risks. The first one is obvious, the risk of losing money. Everybody sees it, everybody fears this one. But the second one is much more subtle. It's the risk of missing opportunities. If you're so focused on just avoiding losses, you're guaranteed to miss out on the gains. Your job as an investor is to constantly balance these two, shifting more toward offense when the market is fearful, and shifting much more toward defense when the market is euphoric and greedy.
And if you need any proof for why that balance is so absolutely critical, just look at this chart. It's stunning. Over a 30-year period, the stock market itself returned over 10% a year. But look at the return for the average investor, less than 4%. Why is there such a huge gap? That gap is the cost of emotion. It's buying high when you're feeling euphoric and selling low when you're in a panic. It is the price people pay year after year for getting swept up by the pendulum.
So, the crucial point I want to leave you with is this. Your job isn't to predict the future. No one can. Your job is to do two things. First, assess. Do your best to understand where we are in the market cycle. Is the dominant emotion around you greed or is it fear? And second, act. Based on your assessment, you adjust your own balance between playing offense and playing defense to put the odds in your favor.
Look, achieving superior investment results isn't supposed to be easy. If it were, everybody would do it. It demands a superior, better than average ability to figure out when taking risks is likely to be rewarded and when it's likely to lead to loss. It demands that you practice second-level thinking. There truly is no alternative. So the only question you need to ask yourself today is this: where on its arc is that pendulum swinging right now?